Hi, good afternoon. Welcome to Cordant's final market update for 2020. Man, it's been a long year, so congratulations for making it to the end here. Hopefully, in these last couple days, you're able to take a deep breath, recharge, and get ready for 2021, a year I'm optimistic about, and I know everybody's looking forward to turning the calendar over to 2021. So, thanks for joining us. We've been doing these market updates throughout the year this year, started them in February, and I think this is the 13th one that we've done throughout the year. So what I thought it would be fun to do as a recap for 2020 is basically just go through some of the highlights, maybe lowlights in some cases, of these market updates through 2020. So thanks for joining us throughout the year and for joining us here. So here's our timeline. Again, we started to do these in February and we've done, I believe, 13 throughout the year. So point of this is just to kind of highlight some of the things we've been looking at throughout the year, and in some cases look at how we did. Were the things we were looking at February actually worth looking at, and how did those play out throughout the year? So we'll start in February and just kind of go throughout the year. So as you can see here in February, the COVID outbreak was starting to be on our radar, on everybody's radar, and what we were looking at in February was how do the markets typically respond to these kind of outbreaks. And kind of what you can see is most of the time markets heal pretty quickly. I think in terms of how this looked, I think obviously things were a lot worse. This is an outbreak that has gone on much longer than I thought, and I think most people thought. But as we did see, maybe wasn't expected in February or March, but the markets did bounce back pretty quickly. The other things that we were talking about there in early February were things could get worse. That definitely proved true, both from a market perspective and just from a health perspective and a pandemic perspective. If you would have told me that we'd still be working from home in December, that I'd be recording this from home at the end of the year, I wouldn't have believed it, but that's the situation we're in. So some of these other things that we were talking about in February, we actually were able to implement over the course of the year, and we'll talk more about those later. But really, February, a lot was unknown, and it was just starting to be the tip of the iceberg in terms of what we needed to deal with throughout 2020. In March, we were already talking about a bear market. So again, it was something that we hit on repeatedly throughout the year. It was the fastest bear market in history, something like 22 trading days from top of the market to bottom of the market, which was a record fast bear market. So what we were looking at back then in March was basically the Forest Service guide for encountering a bear in the wild, applying that to a financial situation. So staying calm, looking as large as possible, move slowly, and hike in groups. So what we were focused on there is staying calm. Returns tend to be strong after a bear market, which we thankfully have seen this year. Looking at some of the other areas of the portfolio that are valuable, and then some of the strategies or some of the actions: rebalancing, tax loss harvesting, accelerating Roth conversions, something we did for clients when it was appropriate back in March. And the idea there was to get more money into a Roth when markets are lower, so you're paying lower taxes for that conversion, and then to realize the recovery, something that worked out pretty well there. Some mortgage refinances as well this year as rates were low. So that's what we're looking at in March. Also looking at just some data on what a bear market looked like and different types of bear markets. We were thinking in March this would probably fall into the event-driven type of bucket, which had typically a lower decline, a lower average rate, and a faster recovery. And so far that's borne out over the rest of the year. The other big news in March was the CARES Act. So we highlighted some of the key features of that, some of the provisions and where the money was going. And obviously now in December, we're looking at the second major piece of financial stimulus that is coming around the corner. And that'll be something that we'll obviously sort through now and in January. On to April. So in April, we started to, we reviewed rebalancing, something that we had done in March for a lot of portfolios across our clients, and just kind of the benefits of that. And so you can see a little bit on this slide. The yellow line is a rebalanced portfolio versus one that was not in the prior bear market, the 2008 financial crisis. And you can see over the period, the rebalancing through this period pays off. A little bit easier to see here. You can notice here that the tendency, if you're rebalancing on a threshold like we do for clients, is you can be early, and that's a negative benefit up front if the markets continue to fall. But as the markets recover, like they tend to do, you're positioned, you're essentially buying more equities in this period, and you're positioned for the recovery. And so this cumulative benefit of rebalancing was something we looked at, showed up in 2008, and again has shown up in this bear market as well. That was April. In May, I was going back and looking through the deck, some of the presentation, and I couldn't find any slides for any market update in March, and in May, and I was scratching my head a little bit, wondering where they were. And it took me a second to remember I was doing something else. So this is Beckham Nash, our son that was born on the 1st of May, and just been a really nice kind of distraction and bringing a lot of joy into our lives in 2020, when a lot of other worries and a lot of other things going on, obviously. So this is a nice distraction throughout the year. So this is what I was doing in May. No market update in May, but in June, next month, we're already back to talking about all-time highs. So something that we were focusing on here is, how do the markets tend to respond to all-time highs? And kind of the big takeaway was all-time highs do not necessarily mean, or don't typically mean, that the market is going to have a negative return going forward. That's not a bad time to be investing. So we looked at some data there. Also looked at this chart that one of the hard things to explain this year was the economy is really struggling. Why is the market going up? And the key point here is the market is reacting to what the expectations for GDP, the economy, is going to be next year, not this year. Much more correlated to next year's GDP growth versus what's going on in this year. So that's the chart on the right. Other thing we started to look at here is, or actually started to look at earlier in the year, but continue to look at throughout the year, is what kind of a drop do we have? A 34% drop versus a 35% average, right in line with average, and the markets tend to rebound pretty strong after a bear market like that. So we looked at 1, 3, and 5 years after a bear market. What kind of total return do we see? And so first point here is that markets tend to bounce back pretty strong. Other point is small caps tend to do pretty well after a bear market. The other thing that we started to talk about is what other areas of the market tend to perform well after a bear market. One of those are value stocks, which we tend to allocate towards for most clients' portfolios, and those tend to rebound better after a bear market as well. So those were some of the things we were talking about at that point. What I want to do is kind of check on how has that actually worked out this year. And so here we're looking at the market, the S&P 500, the U.S. market anyway, and that's the blue line. These two lines up top are the small cap stocks. So purple is small cap stocks, all small cap stocks in the U.S., and that lighter orange line is small cap value funds. The other line, the orange here, is value funds in the U.S. So what you can see basically from the bottom in late March through the end of the year, a couple days ago now, small caps have outperformed over this period. So the data in terms of historically how markets respond, it bore out this time. We did see small caps outperform. Value, not as much. I mean, they weren't a big laggard over this period, but they have not yet over this full period outperformed the market in general. This has changed since about September 1st, which is something we'll look at here in a bit. But over this whole period, small cap outperformed, value did not. In the summer months, we started to look more into the election and what was going on there. So in July, basically trying to make the point that don't mix politics in investing. It's really hard to identify a pattern. On average, markets have been positive in election years and subsequent to election, and there's really no way whoever is in the White House, Democrat or Republican, to make a systematic sort of decision or an investing decision based on that. So that's what we were talking about through the summer. Obviously, things from a market perspective, they've reacted well. This has been an election cycle probably unlike many others in the past, and the markets have kind of powered through it, looked through it, and looked to the future. So I think this advice held strongly throughout the year. In August, we dove a little bit deeper into the election and looked at 3 scenarios. Status quo, essentially Republicans maintain the White House and the Senate, blue wave, a Democrat sweep, and sort of gridlock, which is a mix, White House and Congress. It looks like potentially we're going to get that gridlock scenario there. Obviously still the 2 Senate elections in Georgia here, I think next week, that are going to determine which scenario we get. But it looked at that in August. In September, it started to look at what was going on with the NASDAQ or the tech stocks. Tech stocks obviously did well through the downturn, and through the summer months rallied pretty well as well. And so you can see this chart in blue is the NASDAQ, a lot of tech stocks versus the S&P 500. So over this period, tech stocks did pretty well. And so we looked at what was going on there. So some of it was speculation using options, a lot of bullish options bets in some of the big tech names, Salesforce, Adobe, Facebook, for example, in this chart here. Looked at kind of what was driving that outperformance by tech over that period and what might cause it to change. And so this was an interesting sort of chart correlation between growth or tech names and value names or more of the traditional economy. So things highly correlated to the tech outperformance: Federal Reserve actions, inflation, interest rates. On the flip side, election, vaccine, stimulus. So setting up kind of this, something that we'll look at later, is this transition between lower volatility with election outcomes, vaccines around the corner, which are now being distributed, and stimulus actions, helping to maybe change this correlation, what might change in the tech world. So we looked at that back in September. So what has anything changed over that period? And what we're looking at is basically from September 1st through again this week. That has kind of changed. So tech outperformed over the summer, but judging by NASDAQ over this period, we see small caps outperforming over that period. S&P 500 at 6% and NASDAQ at 4%. So that has changed a little bit since September. In October, we dove into bonds. Do they still make sense given the low yields? Interest rates have really come down this year, and so do bonds still make sense? We reviewed kind of the purpose of bonds historically, helping you sleep at night, kind of providing that safety in the portfolio, helping to increase your withdrawal rate if you're taking money from the portfolio, and have always historically provided reliable diversification in the portfolio. So looked at that, and really just the point here is that they acted as they should have here in 2020. Provided, you see bonds in green here, provided a nice cushion. Obviously didn't outperform stocks over the whole year, but in this drawdown here in March, April, provided a good cushion and were positive throughout most of the year. So bonds, even though rates were lower, still provided a nice level of diversification in the portfolio. In November, just a month ago, we looked at this market rotation more. So in the deflationary period, the recession period, the drawdown period, growth, large cap, tech stocks really had their day. And it seems as of late, last maybe quarter, 3 months of the year, this reflation trade, this rotation, value, small caps, energy materials, rates rising a little bit, is starting to take place. So we looked at that, just a quick update on that. We looked at, as of November 9th, which is when we did our market update then, that how this was looking. So again, small cap here in green, value stocks here, next one, the market in general, and then tech names. So that rotation was in effect through November, and through the end of the year, more or less seen that same order here. So small cap, value, the market generally, and then tech stocks. So that has kind of maintained throughout the year, and we'll obviously see where that goes in next year. So that was it in terms of the market updates in December. That brings us to today. So put a slide in here. You're looking at Santa with a face shield behind a plexiglass plate, taking pictures with kids. So I don't think any of us thought this would be the scenario in December, but here we are. It's been an interesting year. It's been an eventful year. It's been an unprecedented year in many respects. At one point throughout the year, we had negative oil prices, negative spot oil prices. We had a record GDP drop. We had the fastest bear market in history, and we had a record level or a record unemployment claims. And so pretty unprecedented year in many regards, but things obviously recovered quickly. We have record GDP growth from a big drop. We had one of the faster rebounds, and we've had an unprecedented level of stimulus, and it's affecting the economy as well, helping the economy out. So a lot of unprecedented things, and really just want to thank you for being on the journey with us here in 2020. Thanks for watching these. If you're a client of Cordant, thanks for letting us provide you with advice throughout this tumultuous year. So that's it. Thank you. Hope these have been helpful throughout the year. We'll plan on continuing them next year, and looking forward to 2021. I hope you have a great final few days of 2020 and a great 2021. Thanks.